Hi, I'm David Lynn, Head of Investment Research at Altair Advisors. I hope everyone is enjoying a more normal summer than a year ago when we were all in quarantine. The markets and the economy are certainly having a great year so far, and I wanted to share with you a few high-level takeaways from our quarterly commentary. The world economy has rebounded strongly, primarily due to a powerful mix of vaccinations, the relaxation of pandemic restrictions, and massive stimulus and support from governments and central banks. And we've seen consumer and business activity approach normal levels again, and the service economy, which was so decimated during the pandemic, is expanding at strong levels. Global GDP is now projected by the World Bank to expand by 5.5% this year, which would be the strongest post-recession growth in 80 years. But clearly the main risk is the contagious Delta variant of COVID-19 and whether that will force cities and states to restrict activities once again. And certainly the sore spot in the economic data is a slow recovery in the labor market, with nearly 7 million jobs still absent. But overall, we're very encouraged by the trends in the economic data, strong corporate earnings, and solid fundamentals. These things should continue to drive growth well into next year. The abrupt reopening of the economy, along with pent-up demand and overwhelmed supply chains, have pushed consumer prices to a 13-year high. And while inflation is something that we watch very closely, if you take a close look at the categories that are driving the big price increases, it's really in the areas that are closely tied to the reopening, such as used cars, airfare, and lodging. But if you look at healthcare, education, and technology, these are very large and important segments of our economy. These prices have remained largely stable. Once summer is over and unemployment benefits sunset, we think you'll begin to see a deceleration in the inflation rate, and so we continue to remain supportive of the Federal Reserve's argument that the surge will be relatively short-lived. How the Fed reacts to inflation in the second half will be pivotal and is ultimately what investors will be watching. If higher inflation is only temporary, as the Fed says, then there's likely very little for it to do. But if inflation proves to be a little bit stubborn, then the Fed will be very deliberate in how they start talking about the tapering process, since they're going to want to avoid the same mistakes that led to the taper tantrum in 2013. In general, we think the Fed will err on the side of being slow to tighten, and so by moving gradually and providing sufficient notice, the Fed should be able to start winding down its easy monetary policies without too much disruption, and more importantly, avoid any policy errors. You can find our full commentary on Altair's website. Thank you for watching.